Hey everyone, welcome back to Corporate Decoder, the place where we unravel the mysteries of business. And let me tell you, this filing has more plot twists than a soap opera. Get ready because we're diving deep into ZK International Group's latest annual report. Prepare for a financial rollercoaster with unexpected drops, surprising comebacks, and a whole lot of risk factors you absolutely need to know about. Before we dive into the nitty-gritty, if you appreciate getting straight insights from corporate documents, make sure you are subscribed. We break down these complex filings so you don't have to. Also, if you want to connect with other finance enthusiasts and discuss these finds, join our Discord community linked in the description below. So, ZK International Group, primarily operating in China, filed their annual report for the fiscal year ending the 30th of September 2025. This is a big one because it shows us where they stand and where they're headed. Let's get straight to the numbers. Their revenues took a significant hit, dropping by about 34%, nearly $37 million from the previous year. This is a pretty big deal. The report attributes this to a slow global economic recovery, weak demand in China's construction and real estate sectors, and tougher competition. Basically, fewer people were buying their piping systems. One strategy they employed was to cut back on selling products that weren't making them much profit, like their electrolytic nickel products. While this might help profit margins in the long run, it directly impacted their total revenue in the short term. This revenue drop also squeezed their gross profit margin, which fell to just over 5.6%. That means for every dollar of sales, they were only making about 5.6 cents after covering the cost of making their products. That is a tight margin, and with revenues down and costs still present, their operating loss widened significantly to over $4.2 million for 2025. This is a step back from the previous year where they also had an operating loss, but a smaller one. Ultimately, this means they ended up with a net loss of over $4 million for 2025. It is an improvement compared to a massive loss of over $61 million in 2023, but still a loss. Plus, they have accumulated deficits of nearly $55 million. The company is also facing some serious liquidity concerns, with its independent auditors expressing substantial doubt about its ability to continue as a going concern. This is a serious red flag, meaning the auditors aren't entirely sure the company will be able to pay its debts as they come due without further financial support. They're trying to fix this by negotiating with banks for more loans and cutting costs, but it is not a guaranteed fix. Looking at their balance sheet, their accounts receivable, which is money owed to them by customers, actually increased a bit to over $23 million. But alarmingly, their allowance for doubtful accounts, the money they don't expect to collect, also grew significantly to over $8.2 million. This suggests that some customers are really struggling to pay up, and the company is writing off more and more of these debts. Interestingly, their advances to suppliers dropped dramatically. This happened because they stopped buying from suppliers who required large upfront payments, aiming to improve their operational efficiency and cash flow. They also decreased sales of products that typically need a lot of customer prepayment, like electrolytic nickel. They are investing in their future though, with purchases of new equipment for production. This shows they are still trying to upgrade and improve their manufacturing capabilities. Their debt situation is always a key area to watch. As of September 2025, they had over $12 million in short-term bank loans and over $6.3 million in long-term loans. These loans are secured by company assets like buildings and land use rights, which means if they can't pay, the banks could seize these assets. Now, about those convertible debentures, which are essentially loans that can be turned into stock, the maturity dates have been extended multiple times, and it seems negotiations are ongoing about changing the conversion terms. The company states they have the right to convert them at their discretion, but it sounds like a bit of a shaky situation. They also adopted a new equity incentive plan in 2025 to motivate employees. They even issued a significant number of shares to employees as compensation, which is a common practice to align employee interests with the company's success. Let's talk about leadership. Jiang Honghuang, a co-founder, resigned as CEO in October 2025, but remains chairman. Ri Hongma took over as CEO. This kind of leadership transition can be a sign of change, and we'll need to see how Mr. Ma steers the company. And then there are the risks, and for a company operating in China, there are quite a few. They're heavily exposed to the Chinese government's influence, potential regulatory changes, cybersecurity concerns, labor laws, and currency fluctuations. The whole Holding Foreign Companies Accountable Act is also a lingering threat, which could lead to their shares being delisted from US exchanges, if auditors can't be fully inspected. This is a big one. The company received notices from Nasdaq multiple times about not meeting the minimum bid price requirement for continued listing. They did regain compliance for a period, but the ongoing struggle highlights the precariousness of their listing status. Failure to comply could lead to trading suspension and delisting. which would significantly reduce liquidity and make it harder to raise money. The auditors, Fortune CPA Incorporated, are pointing out the substantial doubt about the company's ability to continue as a going concern. They've also highlighted the going concern issue as a critical audit matter due to the uncertainty and risk of bias in management's judgments about future cash flows. This is not a minor detail, it is a major cause for concern. Looking at the balance sheet, total assets have decreased from about $80 million in 2024 to just under $63 million in 2025. Liabilities also decreased, but not enough to offset the asset drop. This shrinking financial footprint, combined with the losses and debts, paints a challenging picture. Despite some strategies to decrease costs and focus on higher margin products, ZK International Group is still navigating a tough financial landscape. Their revenue is down, they're making less profit on what they sell, and they're operating at a loss. The significant increase in doubtful accounts receivable is also a worry. So, what is the verdict? ZK International Group is facing significant challenges. The revenue decline, widening operating loss, and serious going concern questions from their auditors are major red flags. While they are investing in new equipment and have made some strategic shifts like reducing sales of low-margin products, the overall picture is one of significant financial strain. The risks associated with operating in China, coupled with their STOXX compliance issues with Nasdaq, add further layers of uncertainty. Their direction seems to be focused on cost cutting and trying to stabilize operations, but the path to profitability looks long and challenging. The company has a lot of ground to cover to convince investors and auditors that it will remain a viable business. What is your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description. Thanks for watching. See you next time.